Welcome to Virtual Coffee with Dawn Rickabaugh, the Note Queen, where we talk about owner financing and notes. Financial solutions, one mom and pop to another.
All right, here we are. Welcome to the, what month is this? This is June 2018 virtual coffee call. My name is Dawn Rickabaugh, and I'm your host. We're talking about anything having to do with owner financing and notes. And I appreciate you being here very much, spending your time with me, whether you're here as we speak or if you're listening later on the podcast or YouTube or something. Just a quick reminder, my website, notequeen.com. Well, I get emails every once in a while, and I just want to remind people, please don't be offended that I can't, really respond to every email and things like that. The reason I have this venue is so that, people that want some answers and can, have a chance at, being part of our hot seat and part of this venue here, our virtual coffee venue. But outside of that, if you want to consult or get some ideas or spend some time with me, there's a way on my website where you can go to the consultation page. Just because we're a small family operated investment company, and all of us wear a lot of hats, and I'm in the middle of a lot of rehabs right now, and also just closing notes. Just closed one yesterday. Hooray! Nice big one. But anyway, just to let you know that please don't be offended that I can't respond to emails unless you just sort of grab my time from the consultation page. Also, please don't forget to create a free Note Queen account, because if you create a login from the Note Queen site, I've sort of aggregated all of the free content, and there's a teeny bit of paid content if you're interested. But that's an easy way to find what I have available in both free and paid versions. And just a reminder, I am getting all set up for our Property and Paper Summit in 2018, October 1st and 2nd, up at South Lake Tahoe. And it's a gorgeous venue. So if you want to go deeper into these subjects and rub shoulders with people that talk about this, like we live and breathe it all the time, please consider coming to that 2-day event. The website is propertypapersummit.com. And there's links from notequeen.com. There's probably links under this video wherever it's being posted and things like that. So anyway, just wanted to say that I feel bad. I know people sometimes email me and they have all these things that I would love to be able to help with, but just as one person, I only have so much bandwidth. So, and I just love this conversation, and I want people to be able to competently and have a lot of fun and create a lot of solutions, right? I mean, my big tagline I love to say is, go out there and create financial solutions, just one mom and pop to another. It's unplugging from the wealth vampires of Washington and Wall Street, and figuring out to take care of ourselves, our retirement, and each other, without necessarily needing to run to the bank all the time. A lot of times I've started a local meetup group. So by all means, if you're within, reasonable drive to Carson City, Nevada, which is in the Reno, Tahoe area, please come. Our next meetup group is Tuesday, the 26th. That's next Tuesday from 6 to 8 p.m. at Battleborn Social, right there in the middle of downtown Carson City. And people are, often surprised that, anyway, I love to share as much as I can, but I have the meetup group where I do a lot of teaching and coordinating with others. And then I have this virtual coffee call. But anyway, I know what I was going to say is that people are so surprised because they go, well, what about bank financing? And most people are just shocked when I tell them that I don't use the bank for anything. None of my deals that are either cash or owner financing, buying and selling. And I know there's a place for bank financing, but I've just drawn a line in the sand. part of my personal religion or something. And I'm just showing that, yeah, I'm not doing a bajillion deals. We're a small family operated business, but the deals we do put together are on that basis. And most people say, well, I didn't think anyone was, nobody's doing owner financing. That doesn't even happen. I go, well, I'm just going to be one example that shows that, yeah, you can do a whole lifelong business without ever asking a bank for a loan. So anyhow, with that said, Axel, you said Lynette is here?
Actually, we have Lynette Battle, and then we also have Nomi.
Oh, I'm glad. I'm really glad they're both here, because they have now, I think, Nomi was first to submit her. So let's just get to, can you unmute her?
Go ahead, Nomi.
Hello.
Hi.
Hello.
Hey, thank
Hi,
you
how
so
are you?
much. Thank you so much for being here.
Thank you.
Yeah, so I can read your hot seat interest form here. Do you want to just give us so that everyone can get caught up with who you are and, a nutshell of, why you're here today?
Sure, yeah. There's I've been a sort of very small-time landlord for the last 15 years or so. I got from one tenant all the way up to about 13 tenants. Gotcha. And then for a variety of, various personal tragedies and different things happened in my life, and the 13 tenants became this huge nightmare for me. And I also had one owner seller finance note that I was holding. And I was looking at this note was coming in $1,100 a month without any problem. I had already done the work, and now it was just coming in. And then I compared it to what the hassle was with all these tenants. Right. And I just decided, let me do notes. And so I didn't know anything about it. And I've spent the last year or so just researching a lot. Mm-hmm. And I'm on the verge of doing it. And I have some personal funds, and I want to use other private people that I know that are interested in it as well. And so what I was wondering is, one thing I picked up from you was that I had heard about selling partials, but I need cash flow. And you had mentioned that you could sell a partial, but still keep like half the cash flow. And I didn't know how you do the math on that.
Well,
so that was one of my questions.
Hey, that's a great specific question. I love your story, and your situation is very common to people that have been for a while. And it's such a great tool. Not that rent can't be great, but I think diversifying a portfolio, is really nice. And, when you're managing enough of a note portfolio, some of that paper turns into property through default and right. But for the most part, if you do your underwriting, well, then as you must have done on your, did you carry on a property that you had sold or buy someone else's note?
Yes. I sold a property for my dad, and he just basically just assigned the note to me because I did all the work, and nice. We had an agreement. But we basically just drew up a note where she put down it was a property that you couldn't get a bank loan on. So
non-conforming somehow.
Yeah, very, very, very non-conforming.
Yeah,
I'm still holding the note.
Yeah, well, great. I mean, most people, if they really stop and think about it, they need cash flow more than a big chunk of change, because when you get a big chunk of change, then you're like, well, what am I going to do with it? So if you have an insta investment, it's better than most people can do, right?
Yeah.
Yeah. What's the interest rate on that owner carry note, just out of curiosity?
So it's 6%. Because it's in California, and I just can't drive the interest rates up high to here. Seems like.
if you increase the interest rate, you'll have to decrease the price on the home, things like that, because people are willing and able to afford so much. So it depends on the price point a lot. I mean, right? For the most part. So that's fantastic. That's a great return. I don't know that a lot of people are getting that. Just nobody is just leaving it in their their bank or a CD or something like that. So
right, yeah.
And then if you factor in the price differential of what your father probably bought the property for and what he sold it for, the actual yields.
Oh, well, no, that's ridiculous because he bought it for like $5,000 back in the 60s.
So even though what'd you sell it for?
It was around 250. I can't remember the exact price.
Oh my goodness. So, wow, that's kind of like the move in Bitcoin, there last year. So, but
well, it's California between 1970 and 2015 is huge difference.
Oh yeah, fantastic. So when you factor in the, that capital or equity, I mean, your yields probably, I don't know, 60% on this thing. I don't know. I'm just I don't remember, but all right. So going to partial. So you've got this note and it's been performing well and easily, correct? No headaches.
Right.
This money's just coming in. And you're going, gosh, I need some of the money, but I could use some cash for what? Some other investment or some need that
Well, what I want to do is I've been liquidating my rentals in order to start a loan business, just be a private lender, and I want to lend out of state. And right now I'm looking at like Missouri and Texas and Georgia because I have connections there, and because I can't get the same return here in California. So what I was thinking of is if I could somehow structure a partial note sale where I'm still getting some cash flow, I could use the cash to go buy something in another state where I could then increase that note business.
So you're going to be moving to private lending, not necessarily buying the house and doing owner carry, or both?
Either way, I mean, I'm willing to buy a house and then do owner carry, and I'm willing to just buy a note. I just don't want to be a landlord. I don't believe in that anymore.
Yeah, you got a different.
No, there's a whole philosophical thing about the person living there as a tenant, not caring about the place and having to pay this rent, and they don't like you and they resent you, and versus allowing someone to become a homeowner. It's just a whole different thing, and you know that because you write about it and talk about it. So
right. That's that's phenomenal. So, all right, well, let's talk about that. If you're gonna, so I think of all of the things, I would guess between those, buying a note, an owner carry note existing, and being a private lender for other people, most likely rehabbers, things like that, business purpose loans is what I'm thinking, and then buying a house and carrying paper. I would say the easiest of those, the plethora. There's a plethora of, I would say, a lot more available to buy a house and do owner carry, and to work with maybe a loan broker over in those areas. Those opportunities are going to be a lot more plentiful. It can be really difficult. You really have to focus usually quite a bit if you just want to focus on buying owner carry paper. And you can go through, brokers. Like I mostly buy notes and keep a spread on almost everything that comes through my office. But sometimes I just, pass on a note and get out of the way and take a fee. So, but, it's easier to broker long after you've been a note investor for a long time than to go the other way around. That's what I found. But anyhow, so I would say that if you're making a loan, if you're just going to be a lender, there's so much opportunity. You talked about leveraging other people's money, correct? Like,
right.
Some of my money and more of other people's money, and just, get these operations going. And I'm not going to speak to the licensing or the legal things in terms of, I'm not an attorney. And so you'll have to do your due diligence if there's any regulations. But if you go through a hard money lender, you don't charge the points, but you get the deals, right? So they might bring you a 9, 10, 11, 12% private loan opportunity that you can, you won't be charging 1, 2, 3 points on that loan. But, if you leverage other people's money, I often say that the most powerful way to instantly be in the note business and build passive income is to leverage other people's money. The most wow, my words are just not coming. It's like I got cobwebs running around up here. But,
you need another coffee.
The thing, yeah, it must be because I'm only drinking green tea this morning. I should have did it with a little espresso or something. But yeah, the most productive financially is to build financial friends, because even if you got to, like, you have your note at 6%, right? If you can find someone who goes, gosh, I'm only getting 1% or less in my bank account, and you can offer them 4%, you have a 2-point spread upon even just a 6% note. So when you have,
well, I'm actually hoping if I go out of state to get more than 6%. It seems like
absolutely, especially if you're doing business purpose loans to rehabbers, I would say between 9 and 12 should be all day long, I would think.
Right? But how about to consumers?
No, I wouldn't do that. I heard that I haven't heard anyone do lengthy commentary yet, but the Dodd-Frank, I believe, has been dismantled for the most part, but I am not sure, so because of Dodd-Frank.
I was talking about the seller, like where you do the owner like where you buy a house and then just carry paper on it. So, and get it like an RMLO if you need it.
Yes, there you go. Okay, so you already know about that. Just making a loan to the consumer, I would stay away from, until we shake out and we see how the dismantling of the CFPB is going to work out.
Yeah.
But so just use someone who's, well, naturally it's not like you want to set someone up for failure anyway, right? So you want to make sure they have the ability to pay, and that you don't set them up where the likelihood is that you're going to be sitting in front of a judge for a poor little homeowner and you're trying to kick them out of their house, you're just just trying to avoid that situation. So, but so in that situation, just depends on the price point. And I think in the areas you're talking, I don't know, Texas has had a lot of price inflation, but if you're talking Missouri, some of the Midwest area like that, the price points for the houses, are between 80 and 150, something like that.
Well, like for example, I'm looking at a note right now, which is a guy that's facing foreclosure and wants to move out of his house and sell it to his son-in-law, and so they just want to sell it for the price of the note, and the note is $95,000, and the borrower, the house is valued at 140, possibly up to 180, but 140 is definite. And so that's a pretty good spread, and they want to put down 20 grand. And so I would finance them 95 minus 20. I need another cup of coffee. It's 75.
Wait, so you're going to just straight up loan money, or are you going to have?
No, I would do it like a first lien. I would basically be the refinancer. I would pay off their bank loan of 95,000 with 20 of the borrower. And then I would have a $75,000 note that's worth 140 in value of the property.
Okay, so
that's the kind of spread. And so then if I set up a note, what I'm thinking, if I could set up a note that was 8, 9 or 10%, then I could then find another financial friend, as you call them, to come in at 6 or 7%.
Right. Well, here's I'm just trying to back up and make sure I understand the situation. So, there's a property worth, let's just say 140, maybe a little bit more. And the gentleman who is behind on his mortgage that has a balance of 95,000, he's going to sell the property to his nephew or some relative.
His son-in-law. Yeah.
His son-in-law. And for what's the purchase price of the house?
95,000. He doesn't want to make any profit. He just wants to avoid foreclosure.
So are you just bringing the loan current and letting it ride? Because why would you?
He wants to get out of it. He wants to move out.
Well, I understand, but here's the part I'm getting confused about. If the purchase price is 95,000, how do you end up with a note for 140 or 120 or something like that?
No, the note is 95,000. The value of the house, the appraised value of the house, is 140.
Okay, so you're not having a UPB, an unpaid principal balance on the note that's that's 120, let's say.
No, that's 95.
Okay, so you'll have basically there'll be a note for 75,000 that you're providing the money for one way or the other.
Right. I would be giving them $75,000. They would pay off that $95,000 note.
Okay, now I got it. So, but your note, your 75 will give you a note for 75,000 secured by a property
Right.
will double that.
Right.
Right?
Mm-hmm.
Okay, great. So
Yes.
the first question we have to ask is, well, number one, I wouldn't just loan the money. Here's a situation where that's a little dicey from a consumer.
No, I was talking about doing like a first lien, like a bank. Where I'm
Right.
actually on the deed.
You're on the deed. You're
Well,
gonna,
like secured. No, I mean secured by like a first lien mortgage.
yeah. So that's like making a loan, because then you'll have a note and a mortgage or a note and deed of trust, right?
Yeah.
That's what I'm saying. I would suggest you avoid doing that.
Oh, okay.
So, right, because that's making a consumer loan. You're a loan originator, and there's a lot of rules and licensing around that kind of thing. So here's how I would do it: is I would have the father carry the pay. So you structure it the way you'd want the note, but the father carries he's the lender. It's a seller carry back to his son-in-law, but you create the terms that you would take over at par, meaning you don't need a discount on it. So the son-in-law sells the house for 95,000, puts 20 down. He's got a note he signs over to his father-in-law for 75,000. And then what are the terms of that, And so then the father's going to say, okay, I need to create this note so that you don't want to discount the note, right? Because we need all the funds to pay off the $95,000 lien. So you have to go, okay, well, what do I want to make on my money for this, right? So if you're saying, we just have to make sure that the son-in-law can afford and agrees to whatever those terms are, right? So I'm just pulling up do you have a financial calculator, an HP 10B2?
Yes.
Or something? So, when I put in 75, do you know any sort of expectation they have? Have they discussed terms of that note? Like if you
haven't discussed.
Have you discussed anything?
They haven't discussed terms yet, but I know that the local rent in the area is around $1,800 for a house that size.
No kidding.
I know, it's crazy. And that's why it's kind of a slam dunk type of deal.
I seriously feel bad for renters right now in some areas. They're getting so squeezed. But so basically, and so even if we were just matching that, I don't know that they can want to pay that, but let's just.
Well, I thought you could structure it kind of quite a bit lower, like almost half, and still be making a good return.
No, that's what I was thinking. Let's say if rent is $1,800, let's say $900 for P&I, principal and interest. Right? And then they're going to have taxes and insurance and some maintenance, so they got plenty of room. So it's below. So now it's below. It's below rent for them to own because they had the ability to put 20 grand down. So that's fantastic. And in this case, you can't almost lose because there's so much built-in equity to the property already. So if I just, and I don't know if anyone can see this, but that's just the basic loan. If he can easily afford, now I don't know if he'll agree to it, but he can easily afford a 9% return. And yeah, go ahead.
This is Ken, Don. How are you?
Hey, good. How are you?
Good. Hey, Don, I just wanted to comment on what you guys are talking about. Did the lady who's trying to do the note, did she ask the people why they wouldn't just sell it and cash out and be on their way? If it's in foreclosure, you can still sell it. And if it's got that much equity, why would anyone want to leave that much equity on the table if they can get $20,000 or $30,000?
Yeah, maybe. I don't know. It's a great question. But sometimes
they do want to sell it. They want to sell it to me.
No, but why don't they sell it to somebody who wants to give them $140,000?
Are they just
I guess they want to give their son-in-law a break. They just want to get out of they just want to avoid foreclosure and move and give their son-in-law and daughter a place to live.
Yeah, it sounds to me like it's part of early, inheritance in a way. Look, I'm handing you $50,000 in equity.
Yeah.
But
and that's why I feel like it's.
Has she got the appraisal done on the house already? Has she got an appraisal on the house?
No, they gave me an appraisal for 140.
When you say they, who did the appraisal?
I guess they have a realtor that contacted me that I know, and he's kind of getting together the material on it.
I would get a regular appraiser
so I haven't,
in that house.
Yeah, and those are great questions. So, and things that would be part of your due diligence. So Nomi, what you're just sort of wondering is how do I structure it? And then if you're going to leverage someone else's money, how would you do it, sort of thing?
Well, I was just wondering, like, let's say I did this loan and it all goes forward, and I have the $75,000 note, $75,000 of my own money in there,
right? And
I want to just say, hey, I have a friend that would love to be in my business and get a certain amount of interest. That's maybe they'd be happy with 6 or 7%, and I'm getting 9%. Well, then how do I sell them some of that $75,000, like a partial, but still keep some of like half the cash flow?
Okay, now that's a great
question. So that I could go turn it over to the next.
Right. Ken is bringing up a lot of points that there's a lot of things for due diligence, but I think we're just talking about an idea here that I want to finish before we go too much further. So I'm just going to assume that they're going to agree to, you'd be willing to do 9%, right?
Right.
So I'm going to assume that they're going to agree to that. We're going to make some assumptions just to get through this. So if I put in a $75,000 loan at 9% and they're paying $900 a month for principal and interest, they can fully amortize that in just over, that's 10, 11 years. Looks like if we make it 11 years, their payment would be $897.06. Okay, so, and there again, I am suggesting that you do not make an origination. I suggest that the father-in-law carries the paper, and then after he receives one payment from them, he assigns the note to you. Then you can't be confused with an originator and all the other regulations that would then apply to you. Does that make sense? Mm-hmm. Don't originate it, buy it on the secondary market, but just have the father-in-law set up the terms that you will buy at par, meaning you're not going to say, because if he carries it at 5%, you're going to need to discount that $75,000 note to be able to buy it, right? So you don't want that because we need the $95,000 to pay off the loan, right? Right. So I'm just making that point. So here's what how much money would you be looking to get back out of it? And so, like, if you have this friend that wants to get involved with you, how much money would you be wanting to bring off the table?
Like, if they wanted to put in 30 grand, for example, I don't know the exact number, but let's say around 30 grand.
Well, you could co-fund the note, right? You could have a percentage of interest in the note, a fractionalized interest in the note. That's one way to do it. But if there's a yield spread,
can you just say what that means? I didn't understand that.
Pardon?
Can you repeat that? I didn't understand.
Yeah, so, I mean, I'm assuming that you want the yield spread on top of their money, but so there's if you're making origination, you can wrap. I like the wrap technique a lot. You can wrap someone else's money. So they have a first position for $30,000. It'd be nice if it was a little higher, actually. You know, the more leverage you get, the higher your yield's going to be, and you're still keeping it safe. But anyway, let's say the $30,000. And you wrap it with a $75,000 that includes their $35,000. So you're going to have, in the 9% note, if you're making origination, which again, I'm saying that I would discourage you from doing in this situation, right? Don't buy it on the secondary market. Go through the back door. Don't go through the front door in this. So anyway, you got $45,000 of your own money. And so your $45,000 is making 9% because that's the face rate on the note. And how much do you think your friend would be happy with? 6% or something?
Maybe 6 or 7, maybe like, let's say 7.
Okay, so then you're making a 2-point spread on $30,000. So that has a way of, so I'm going to just, people might not be looking at this now, but it'll be in the video. I keep pushing up my phone where I keep my calculator. But so here's what I'm going to do. So in the case where you're not going to, so if you were going to wrap it, I'm going to do that, and then I'm going to show what I would do if you're going to buy the note from the father-in-law. Okay, so
Okay.
in this case, so what we're going to do is figure out, okay, what does my friend need? If it's fully amortized over 11 years, okay, so I'm going to assume that they're just going to keep a piece of it, right? So I just have to figure out
Can they do it like a shorter time? Because they want to do like 5 years.
In that case, then you'd have to give up most of the cash flow to get them out sooner. You'd have to give up most of the cash flow, right?
Oh, okay.
And then you keep the remainder interest in the note. So if they're not willing to ride the full term, then they get probably all the cash flow. I don't know how it would work. They're willing to take 7%. Yeah. 30,000. If they get the whole thing, actually if they get the whole thing, they'll be out in like 3 years. If you give them the whole thing. If they'll take 60 months to be paid out, they need $594. That leaves you a couple $100, right? $200-300.
That would work. Yeah.
And then after they're gone, then the whole payment's yours, right? So
yeah.
So that's great. So should we just figure that?
Yeah, because that gives me, I need that little bit of cash flow.
Right. Okay. So a couple $300 would be fine for you, right? So,
That would be,
right. So basically you're going to get, I can't remember what our other, so about 600, and I think the payment was 900. So it's about 300 a month. Right. So if I use the calculator, just for kicks and giggles, okay, if you put in 45,000, and then you get 360 times, and then you get, oops, that has to be a negative number, and then you get, you'll get the whole 900. For what's 100, so 5 years, 6 years, 72 times. Let's see, it looks like, it's not as good as it could be with more leverage, but that 9% note actually gets you, looks like 9.5%. Right?
okay.
So if you were to, that number would be a lot higher. You could easily, if you leveraged more like 60,000, and they would ride a little bit longer with you, for instance, you could easily probably push that up to, I don't know, wouldn't surprise me, 11, 12% on your side for your money or more, right? So, but anyway,
great.
So that's if you wrap a loan, but if you buy a note at a discount, then you're selling off a partial. It's the same concept, but the paperwork's just a little bit different. And I'm just going to assume that someone will come in and write it out with you. So if they just for kicks and giggles, for purposes of this conversation, right? So I'm just going to assume that they gave you maybe, let's see, I wonder if they gave you 60,000 just for, if it was 132, no, what would they need? No, they can't give you that. Okay, so if they were going to write it and they needed 7%, and they were going to get half the payment, a $900 from the borrower, and you wanted to keep half of it. So basically, and if they're willing to ride the full term, well, it's really going to be 131, right? Because you're going to let the father-in-law keep the first payment, and then you'll take an assignment of his note and deed of trust or note and mortgage after that, right?
Okay.
You know what? Do you remember why I said that? Just because.
Yes, so that I'm not originating the note.
Correct. So it really gets a buffer so that there's no, the last thing you need is a big legal problem in how you structured it that can invalidate your lien, right?
Right.
So they would have to put in, if they're willing to take 7% interest and they're willing to ride the whole 11 years with you and they get $450 a month, then they need to bring in $41,135. So basically what you're going to do is, I know there's other ways to do it, but if you were, then you assigned the note to them, or when I'm buying a partial, I take a full assignment of the note, and then when I get my part, I put it away, and I think that I give it back to them. So like if I've only bought 5 years worth of a note or a partial of a note or whatever, I take the assignment so that if something goes wrong, I can protect my interest. When I'm bringing in other people, I do the same thing, but I keep control of the original paperwork, right? So that and the servicing, so that I can stay in control of the situation. There may be also ways that you can create a lien against the note or a hypothecation against the note, but whatever your joint venture agreement, if you don't want to fully assign someone the note because it's a partial payment, it's almost like they're hypothecating almost. So you can keep the assignment in your name, or the note in your name, and the deed of trust in your name, and then your other party can have some sort of recorded claim against that note. Now that's a question for attorney, and depending on that state and all of that, but just there's more than one way to do it. But the idea is you're gonna, for someone's going to bring in 41,000 and you only have to bring in 33,800 to get half the note. So they have to bring in, 7,000, 8,000 more than you do to get half the payment. So your yield is going to be higher. Does that make sense?
Right. Yeah, that's perfect.
Yeah. So you would have someone else service the note. You get the payment. You send your co-investor their money, and you keep what's left. So,
is there a way that you could summarize the math for that? Because I heard you do it, but could you just say one more time the steps to figure out the math?
Okay, are you on the video, the computer?
No, I'm on my phone.
Okay, so basically what I did is figure out just for that last example. So if they're going to keep half the payment, I put in payment, there's these 5 little buttons across the top of
right.
calculator.
Yeah,
right?
I have that.
I put in 450, and I put in their yield they need, and I'm going to pretend that they're going to ride the whole 131 months with me, and then I figure out.
Okay.
So and future value is 0 because it's a fully amortizing note. There's no balloon, and so then I solve for PV, present value, or loan amount, and that's how I figure out how much they have to bring to the table. If they're at 7% and they want $450 a month, so I just solve. So whatever, right? If you have 4 numbers, you can solve for the 5th.
So you're basically saying, okay, what's half the payment, and then you're backtracking to figure out how much they need to put in, and then whatever's left over is yours. Okay, I think I got that. Right,
and so then you only have to put 33.8 for your half to keep your half. And so your yield is actually 11.29 or something like that.
Perfect. That's exactly what I was trying to get
So
at.
that's the power of arbitrage or leverage, the spread. That is so powerful that you're keeping half the note and your friend's getting 7, but because of that yield differential, your money is making over 11%. So
perfect. That's exactly what I want to do.
Okay, great.
Yep, it definitely does.
Okay, thank you for that. It's been a fantastic example. Any questions, comments, follow up to that?
Don, this is Ken. I just got one quick question on the assignment that the father-in-law is doing.
Yeah.
Does he actually have to do just a real transaction and come up with $75,000 of his own money, and then he assigns that note back to?
No, No, I would structure it. I mean, this is provided that he's not like has foreclosure date tomorrow, right? If he has a little time, and hopefully they can get him the time, but just ostensibly, if everything worked out, he's just going to do an owner carry at the terms that she'd be willing to lend at. It's just that so that she doesn't have to ask for a discount, so that she can take the note at par. So he would do an owner carry. So it's like go into escrow, sell your property for 95. The son-in-law brings in 20. He carries back, and of course that's wrapping. So
there's no money. So there's no money anyone's coming up with at this point.
No, he's just getting out of it and leaving all that equity to his daughter.
Right. Okay.
Yeah.
And the due on sale thing doesn't make that a problem?
Because in 1 month, you're going to be buying that note and cash out. So yeah, there's literally no chance of the due on sale that anyone calling.
Oh, great.
Right?
That's good.
I mean, it would take them, even in the, at least right now in what we have going, there's just no chance that they almost never accelerate anyway. Maybe 2 or 3% of the time. Now, if interest rates go through the roof like they did in the 80s, yeah, they'll probably be trying to call in those low interest rate loans and look for excuses to, pull in the money and then lend it out at higher rates. But I would say you really have no trouble. So that 75 owner carry is going to wrap the existing bank note, and then you're going to buy that bank note at par, so that the bank's paid off when you buy the note. So fantastic. It's a really great case study. I love it. Now, there was somebody else. Thank you very much. Once again, Axel, is there any chat or things we need to address, or something that you need to, housekeeping items that you might need to say?
Not at the moment.
Okay. All right. And, there was someone else that had, I want to say, okay, so, yeah, there was another guy, Matt Skog, who...
Matt did not make it on, but we do have Lynette with us.
Yeah, great, because he was asking about the partials, because partials and leverage and things like that can be so powerful. I mean, a lot of times, anyway, when I'm buying something as a rainmaker type, I'm in the business of making money, putting these deals together and holding for cash flow, all of it. I do a little bit of everything. Sometimes I take money out front of a deal if there's room in it and I need it for something. If I don't need cash for something like I do right now, I'm spending money hand over fist rehabbing properties that are for a long-term, portfolio, handful here locally. But anyway, I would rather not take the cash now. I would rather keep a piece of the note, keep a piece of the payment, and sometimes I keep none of the payment. So I'll bring in an investor to bring in all the money, and because of the yield differential, after they get paid off, let's say after 10 years, they're all paid off and they put up 100% of the money, and I still have 5-10 years to collect on the backside. So that's part of my retirement account, right? And if you do that inside of a self-directed IRA, there's absolutely no tax liability or deferred tax, right? So you can take money up front and none of the cash flow. You can keep a piece of the cash flow, or you can take none of the cash flow and have a stream of income that's due to you, to start 5, 10, 20 years down the road, depending on the situation. So I like doing a little bit of all of that. So it's just so flexible what you can do, and you can do it with loans by doing that with other people's money, or if you buy discounted paper or you buy properties and carry paper, then that's how you invest it in a note. So there's really no end to the wizardry. And that what I like about the Property Paper Summit is that you'll get so many ideas that'll make your head spin about different ways you can actually make the numbers work, and it can really astound you. It's not hard. Once you learn the leverage of other people's money and putting these deals together, it is not hard to make 20% plus returns with your own money, sometimes a lot more. For instance, if somebody came in and bought a note, or someone put up all the money to buy a note, how much of my own money is in it? 0. and I still keep the last 5-10 years of the note payments, starting down the road. So really that's kind of an infinity return. Of course, I spend a lot of time and money and effort to get to the point where I can put the deals together, right? I can have access to deals and I know how to put them together, but really none of my own money is in it. And I have cash flow coming. It's passive income out of thin air. It's life-changing, absolutely life-changing. Okay, Lynette, let's talk to you. Hi.
Hi. How are you?
Great. Where are you hailing from? 301.
Well, that's my old number from Maryland, but I'm right now in Charlotte, North Carolina.
That's a great city.
Yeah, I enjoy it.
Yeah, it's beautiful over there.
Yeah.
So give us a little story about you.
Okay. Well, I've been in real estate for a number of years. I went through the education route, and we did some real estate, but we lost quite a bit of money. So my husband started his own business when he lost his job, and he couldn't get his salary. So he started his business, and I kind of focused in on helping him with his business. And since then, we were doing rent to own, and we found a lot of people were not able to keep the properties and things like that. So while I was taking a little break, I just started doing some research, and I really like owner financing. I really like the note business. And so that's where I want to focus my attention. We're right now we're about to sell our home. And because we have such a great mortgage, we modified our mortgage years back when my husband lost his job. And right now it is, we would like to owner finance our own home. But I have a couple of problems. One, when I originally put it on the market, I tried to do, when I did 3 to 5%, I got lots of phone calls. But then when I changed it to like 10%, which is what we need, the phone calls kind of stopped.
So you're advertising a certain yield in your ads?
Yeah.
Oh, okay. What's the I might not want to do that if I were you.
Okay.
But
well, the reason I did it was because I was trying to weed out people, but I guess I weed out everybody.
You became the instant high bidder for your home.
Correct.
Yeah. So do you mind talking to some real numbers? Can you tell me what your house is worth? I need to know what price point we're sort of talking about.
Okay. Well, right now it's kind of weird because where our house is located, it's located in a development where houses are, different numbers. And so to get a comparable for my home is really, really kind of difficult, mainly because it was the builder's home. So we are just, it's anywhere between $550 and $560. We owe $320. And we're trying to, because there's some repairs that need to be done, we're trying to sell it for $480, anywhere from $450 to $480.
Okay, would it still be FHA financeable? Without repairs?
Yeah, it would. Yes.
Okay, so there's nothing that would stop a FHA or conventional lender from lending?
No, not at all.
Okay, so $480. Have you tested that price?
Price? I didn't test $480. I know when I tested $450, it went off the charts. And since then, I've seen a lot of houses that do not compare to ours that are on the market for a little bit more. So $450 was, I guess, everybody's dream price.
Okay, so all right. That gives me an idea. What's your loan mod? If the loan balance is $320, what are the terms on your mod?
They are 40 years. Well, there's two. There's one that's off the top of my head, I couldn't tell you because I don't have the paperwork in front of me.
You know about what the interest you're paying on it?
Yeah, our interest is 2.5%.
Nice. Okay. All right. So and amortized over 40 years. So you have a lot of juice there. I mean, you can easily do a 30-year loan with someone.
Right.
So why do you say, tell me why you're saying what you need, like your situation and why you need 10%, because in that price point, it is completely unrealistic. You can get,
Yeah, it is.
yeah, I mean, someone to give you your price, they got to have like relatively close to market terms, maybe a point or two above what the banks are giving. You know what I mean?
Yeah.
Yeah. So otherwise affordability is like ridiculous. It's not affordable.
Yeah. Well, the reason why I say that is one, we have to move, and just money for that. And then to start my own note business, I wanted money for that.
So you need 10%, like you were saying, I need so much per month, or why wouldn't you just sell for cash and take that cash? And
I could take the cash, but I just, I could, and we can, that's not a problem at all. It's just that the setup could be so nice doing it owner finance.
Yeah, because then you're insta invested in notes, right? You originated as a homeowner.
Exactly.
And you're exempt from Dodd-Frank. Of course, you'd want to set it up right anyway. But, it just may be smarter to just sell for cash and not worry about it. But let's just pretend that, you did find someone that can't get a bank loan, but they can afford it. If it's a 480 purchase, did you think about how much of a down payment you're going to require?
Anywhere from 3 to 5%.
Down payment?
Yeah.
No.
Well, see, that's what I mean. When I did the 10%, that's when I started losing all the phone calls.
Oh, I say that was a down payment, not a yield. You weren't advertising. Oh, well, if people who are buying a $500,000 home can't come up with 10%, they're going to have a tough time. I mean, what is FHA requiring? 5 or what, 3.5? I don't know, but that's a jumbo loan. So I think it's going to be higher probably, right? I don't know. What are the markets doing? But there is no way you're going to take less than 10%. I'm telling you right now, you should, that is too much risk. And the last thing you need, if you're starting over and starting fresh, just take your cash out of it, because what happens if the market goes down a bit? If the market drops 20%, now you're underwater and you get a house back that may be in poorer condition, and maybe the market drops even further, and boom, there's all your equity evaporating right there. So if you don't get a 10, ideally 20% down, I would not do this. Because the larger the large properties are going to be more subject to depreciation, in my estimate. If there's a housing crisis or any sort of crash or recession again, the big properties that go down before the bread and butter ones, right?
Sure. Yeah.
So yeah.
So here's my other problem. We get all this money, and then it's subject to taxes and all that good stuff, right?
Well, don't you have you're married?
I am.
So you guys have 500 that's going to be the homeowner's 121 exclusion. You have up to $500,000 that's protected. You won't have capital gains on this.
Okay, great. Okay.
Yeah. I mean, I am not an attorney or an accountant.
Okay, no.
Wow, I just made a big mistake right there.
No, I'm going to look into it.
I mean, why would you take, I'm the note queen. I mean, who calls themselves that? This is for entertainment purposes only.
Sure, right,
so
I understand.
Everyone do their own thing. But I'm pretty sure you won't have capital gains. And if you, I would not risk it. I would just get it on the market and don't be greedy. If you really just need to sell quick, then price it to sell. If you, I know it's hard to get comps, but if someone comes in and says, hey, solid price all day long is 480, then list it at 469.
Yeah, we don't mind leaving money on the table at all.
No, because for speed and ease, and you just don't want to be hanging out there very long, in my opinion.
Very good.
But if you didn't need the cash, wouldn't it be great to leverage 2.5% money, right? If you did not need the cash and you could find someone that could bring 10 to 20% down, and even if you only charged them 4%,
Yeah.
You
Well, see,
know,
if we got 10%, if we got 10%,
cash flow.
yeah, if we got 10% down, then we could do it all day long. We could keep it.
Right. And then it makes sense. And then you just have to have some sort of disclosure and discussion with the buyer. Say, look, there's a possibility that the note could get called. And if it does, you have to have that discussion up front. Who's going to refinance? Who's, blah, blah, blah. Now, I took a property subject to a loan with a 1% loan mod. So, I structured the deal in certain ways to minimize the chances of acceleration, let's say. Yeah. And so there's things you can do that are a little outside the box, to minimize the chance of acceleration or that due on clause being activated. But anyway, most people can still run quite a few years with it before they even have to think about it. But if you always have to have that discussion, like, what if, this really happens, what are we going to do? And not make it a big surprise. Right. So.
Yeah. Yeah.
Okay. Well, that's great. Anything else? We're almost out of time here. Does that help kind of what you were?
It helps tremendously. Thank you so much. I really do appreciate that. So in other words, you would just not put in the 10% in the ad, just seller finance, because I had a lot of people who just came in and they just wanted to buy the house out and out for the price. They did not want to do seller financing. We have more of that.
I don't know. That's pretty juicy to me, because cash in your pocket can be, if you're starting over and you guys seem like you had a reset, one or two.
Yeah.
Cash in your pocket versus, if this is a significant part of your financial wealth of your family, then I would just get it off the table probably. If it's left in a higher end home, what if prices cut in half? There's too many what ifs where even if you put the money in the bank could take it too. I don't know. Nothing is 100% safe, but you want the chance to be able to diversify if this represents a pretty good chunk of, your nest egg.
Sure.
So I probably wouldn't leave it at risk in this situation,
Okay.
but that's just my opinion.
Okay, great. Thank you so much. I appreciate it.
Thank you so much for being with us and spending the time. A great chat. So we are just about at the end. Is there anyone that wants to chat in our last couple of minutes? Axel, has anyone chatted anything that we can address, or should we just open up the lines?
Well, Mira, she wanted to know, for your local meetups that you're doing, can you broadcast that like live?
Yeah, I could. It's just too much. It's really difficult technologically. And then if the Wi-Fi isn't good, then it cuts out. And so
maybe you could record the audio, maybe share that.
Yeah, I'll have to look into that. Yeah, I have the microphone thing set up, but I'll work on that. That would be a good idea for me to record those. We had so many sound problems in our other venue, so we've got a quieter venue now. But I'll look into doing that. That would be an obvious thing to do.
Great.
But me in tech and all of that, I'm not especially, gifted in that way.
Alan here says, don't be a landlord, be a loan lord.
Loan lord or lien lord. I've heard that too.
Oh,
right? A lien lord, loan lord. Definitely.
And Brandon here says, I just want to say hello. I've been working on getting incorporated and secured financing for a hard money lender who does asset-based business loans. I don't know if you know that answer.
Oh, business. He's looking for a business loan?
Yeah, asset-based business loan.
Yeah, that's not my low-hanging fruit. So, I'm really just kind of simple. I just do really simple. They're not, I mean, yes, you can get wizardry like with the calculator, but like I just do like mostly just simple property deals, simple. I don't deal with, any institutional financing whatsoever. It's always mom and pop type paper. And I like to stick with the bread and butter. I don't especially like doing properties that, are out above the median priced home, because when you get into a situation, if the market gets soft or something, you just want a house that there's a lot of potential buyers for and that is affordable to people. So I'm at median priced or below generally. If I do a bigger deal, it's because, there's some other extraordinary aspect to it. So, and it's just secured by real estate. That's all the things that I really know how to do. I know there's a lot of other tricky things out there, but that's just not my gig. So we are up. I just want to thank you once again. It means a lot to me that you would spend the time to be here. Again, if you would like to engage on your terms, on your time, please visit notequeen.com and look at the consultation page. And just remember to use your powers for good and go out there and create financial solutions, one mom and pop to another. Thanks again. You guys take care. Until next time.
You've been listening to Virtual Coffee with Dawn Rickabaugh. For more, please visit notequeen.com.